Good afternoon. This is Craig Modelmog with Cornerstone Wealth Management, and welcome to this week's version or episode of Wall Street X's and O's. Today is Friday, August 21st. Hard to believe that August is about gone. It's crazy. I'm still trying to get over that 2019 is over, and here we are about 3/4 of the way through 2020. So it's crazy. Things are cranking. Hey, we've got a great show today. Lots of good information, lots of really good facts and figures, and really excited to kick this thing off. But to get started, my disclosure, all of the facts and opinions on this show are mine. All the facts are believed to be from reputable sources, and they are facts. They are, I'm telling you, but I have to throw that out there just because, this is not a solicitation to buy or sell anything. Investing does come with risk. They are not FDIC insured, and investments can and will lose money. I can promise you that. After doing this 27 years, I've done enough of that. Anyway, kick things off. We've got a great show. We're going to talk about the fan mag effect. Yes, fan mag. I said it. I know you're just on the edge of your seat here. Controversial elections and their impact on the markets. Yield curve control. Interesting, huh? Permanent job losses. Yes, I got hit on unemployment because, that's kind of the name of the game. Warren Buffett is buying gold. Fascinating. This is a good one. And then we're going to close this out by earnings per share beat rate is near a record high. Interesting. Kicking things off here, FanMag. What is FanMag? First of all, it is Facebook, Apple, Netflix, Microsoft, Amazon, and Google. These 6 companies, number one being huge, are really driving performance of both the S&P and the NASDAQ. In fact, through July, the S&P was up basically 3.8%. Here's what's fascinating. If you take those 6 companies and you remove them from the S&P 500, so you basically have 494 plus or minus. Okay. You know what the performance is year to date? Any guesses? Minus 5.4. Interesting. This is what I call concentration risk. When you look at a portfolio, they say any position in excess of 20% provides a highly concentrated position risk to your portfolio. These 6 companies make up in excess of 20% of the S&P 500 and close to 40, maybe in excess of 40% of the NASDAQ. So these are big things. I've been talking about narrow participation the last several weeks, and this is just another kind of stake in the ground, really showing numerically or statistically speaking how big these 6 companies are. Apple, for instance, let's pick on Apple here. Not that I don't like Apple. I own an Android phone. No offense to Apple, but Apple in itself represents 7% of the S&P and over 14% in the NASDAQ. That is a big deal. That is a really big deal. On to the elections. Hey, big week. Democratic National Convention kicked off. Got the Republicans teed up for next week. You got to talk election risk. I tend to be more middle of the road. To be candid with you, I shot out a tweet here the other night, and I'm like, you know what? I'm kind of tired of the 2-party system. I need a third party. I just get tired of the rhetoric on both sides, and I find myself, I really don't completely identify with either party. Just saying. But anyway, if you look back at what's happening here, the pandemic has really spurred several states to expand mail-in voting. Okay, this has become a really big deal. Each state basically gets to set its own rules. So Colorado will have its rules. California will have its rules, and so on. Okay. The problem with this is this, and I'm not saying it's a problem. I'm saying we're going to have a delayed response in knowing who the victor is. Okay. Trump's questioned this. I don't know why everyone's pinging him for him. If you look over the last decade, both sides of the aisle have complained about it to some extent, one way, shape, or form. So is this the first time that this is being discussed? It's really not. But they hate Trump, so they're going to bang Trump. But anyway, here's what the deal. And then he also raised the possibility of contested elections. Okay, and that's really what I want to focus on, because unfortunately, markets hate uncertainty. Okay, and politics is is not excluded from this. If you go back to through the 1900s, okay, so we're going back, 120 years. There have been 4 major contested elections. We had the battle for Ohio in 2004. You had Bush Gore, which was a presidential election. In 1960, we had Illinois and Texas. Huge debate in 1916, President Woodrow Wilson, his reelection. Okay. Now, these 4 were by no means the only close elections. We've had lots of them, but these were the ones that really carried into the next day, meaning they don't announce a winner, no one concedes the night of the election, and they carry into the next day. All right. Now, if states are dictating how this is to be handled, whether it's something, well, you have to have it in postmarked on the day of the election, or they have to be received by the day of the election. These little differences from state to state are what could cause a delay in the results, okay? And to be candid with you, regardless of who wins this stinking election, it is going to be contested. I'm just throwing that out there, all right? The problem is this: most periods of election confusion, emphasis on most, okay, that's a very strong word, have been associated with weak stock market performance. So we have to start preparing, okay? We know what's coming in November. Things are just getting amped up, all right? You think things have been fired up thus far? We're just getting started here. This thing's going to get really amped up. We have to start thinking about positioning portfolios as we're moving into November. It's not making wholesale changes, because what I'm doing is I'm really positioning based on the economic drivers that we're seeing now. We're not speculating on what's going to happen. Speculating is not investing, it's speculating, okay? Moving on here. Yield curve control, this is a big one. Perfect example of this. I'm going to kick things off. The Bank of Japan in 2016 came out and changed its policy framework. And it basically said, we're going to take our 10-year government bond and we are going to peg it at virtually a 0% interest rate. Now, what does this mean? They peg it to 0%. One, their interest rate environment had been cut to 0, kind of on the path we're on, assuming it continues to get crappy, okay? What they were committed to doing was they were going to do whatever they had, meaning buying debt on all parts of the yield curve in order to manipulate the asset price of the 10-year bond. Okay? This is not good. Has Japan been a healthy economy? No, it hasn't been healthy for 4 stinking decades. Okay? This is a bad thing. Now, let's look at our Federal Reserve. Our Federal Reserve, do they exercise yield curve control? Yes. Oh my gosh. Yes. Only on the front end though. Whenever the Fed makes rate cuts or raises interest rates, it is on the front end of the yield curve. Okay? Short-term rates, that's what our Federal Reserve has the power to do. Now, what have they done? Financial crisis, they started buying bonds, okay? They started buying up their bond portfolio, which is in the form of quantitative easing. So this is something that they are doing to try to, I'm going to say manipulate, that's a strong word too, the yield curve. That's what they're doing to try to keep the yield curve in a normal, and say I'm going backwards because that does it right, because it goes left to right. I think this looks left to right to you. I don't know. If it not, we're going to go this way, left to right. They want a nice looking yield curve. They don't want an inverted yield curve, short-term rates here, long-term rates here. They don't want a flat yield rate curve or yield curve. Japan, everything's at 0. They want a normal yield rate curve. That's what they're working on, okay? Here's the deal. Wall Street right now thinks that we are in an economy where we have growth that is increasing and inflation that's increasing. The problem is this: if that were the case, we would not be having growth in technology companies and growth in the treasury, which means people are buying treasuries. The long end of the yield curve is what tells us what's happening. You've heard me say probably 100 times, the bond market dwarfs the stock market. And if you really want to know how healthy the economy is, look at the bond market. What's happening is this. What are we seeing with bond yields? At the end of today, oh shoot, fire, I just jacked my screen. Oh my gosh. See, I told you this is like totally unedited. Oh, there we go. I saved it. I pulled the big save. You gotta love that. Today, bond yield. See how quickly I just jump bang into it? It's because I've been doing about 20 of these now. I just can kind of wing it with the best of them. I'm like I'm not throwing stuff anymore. I'm calm. I'm delivering a good message. I'm not screwing around like I did when I started, because I was probably nervous. But anyway, here's a good idea. 5-year bond today closed at 0.27%. The 10-year closed at 0.64%, and the 30-year closed at 1.35. Here's the deal. When fear or lack of confidence in the equity market exists, people buy bonds, driving yields down, okay? They're driving yields down with concern. If we were in a growing economy, i.e. what the government and everyone on the stinking planet thinks is happening right now, it's not, but that's what they think, we would not have yields continuing to sink down, because people will be pulling money out of bonds and buying stocks. Well, we know they're only buying 6 stocks. We talked about that at the beginning. So right now the economy is not as healthy as what the government and everyone else is saying. I've been pounding the table for weeks on this. We are in a declining growth rate, and we are in an accelerating inflationary rate. That's why gold has been performing. That's why commodities have been performing. That's why tips have been performing. That's why tech has been performing, because tech actually works in this type of an environment. So anyway, you got to love that. Moving on here. Permanent job loss. Let's look at unemployment. I had to go there. I had to go there because it's important. There's millions of people out of stinking work. This last week was not a good week. 1.106 million people new filings for unemployment. That was an increase of 135,000 week over week. PUA claims increased by 53,000 to 543,000 PUA. That's pandemic unemployment assistance. Continued claims did drop, but again, for the 3rd week in a row, this lags a week, so don't get excited like Wall Street did. Oh, continued claims dropped. Yeah, it's a week delayed, people. It was at 14.84 million people. Total claimants, this is on all multiple forms of unemployment assistance, dropped to 198,000, but it's still 28 million people on some form of unemployment. That's not healthy, okay? I'm just telling you, that is not a healthy economy, all right? Moving on, Warren Buffett buying gold. This is cool. In a letter, and I love Buffett. He's a good dude. I've actually driven by his house in Omaha, Nebraska. It's a big house, but it's kind of a normal house, It's not something a billionaire you would think would own. But in 1997, he wrote a letter to his Berkshire Hathaway shareholders, and I love Berkshire. Love that. Last year, he said we purchased, and this was 1997, okay, 111.2 million ounces marked to the market that positioned or produced a pre-tax gain of 97.4 million for us in 1997, okay? Let me give you some background here. Buffett does not like gold. He's stated that time and time again. I don't like gold because it doesn't pay a dividend. It doesn't do anything. He's poo-pooed it. He's bought in gold only a few times. Newsflash, guess what he did last week? He announced that he started buying Barrick Gold and some gold again. Fascinating, okay? Now here's the deal. Gold is no longer the official link to the dollar. We're going to do a little history lesson here. In 1971, for you historians, you probably remember Richard Nixon removed the dollar being based in gold. All this was a convertibility deal, meaning if you owned a dollar, you could literally go convert dollars into gold and receive gold, okay? So it was the gold standard. So whenever you hear that term, it means the dollar was backed by gold, which provided stability. This really started back at the end of World War II when the whole world was a stinking mess. And the US dollar was going to be the one world currency, and they were going to back it with gold. Okay, all the other countries that were participating in this deal, which at that time there were 44, I think 44. I'm looking at my cheat sheet here. I think there were 44 countries. 44, 1944. Anyway, there were a bunch. Okay, there were a bunch of countries. And what's interesting is this. They were going to fix their currency on the US dollar, and they were not going to adjust it except under exceptional situations. That's changed a little bit. That's not happening anymore, okay? So we had the Nixon shock in 71. When this switch happened, the US dollar just cratered, okay? Here's what is happening. And what I've been saying, why do we own gold? Why do we own commodities? Why do we own tips? We have deceleration in growth. We have an acceleration in inflation, okay? What this means is that the dollar's value relative to gold is going to continue to deteriorate, potentially to a significant amount. I think the dollar's down about 10% year to date. Yeah, 10. Count them, okay? This is probably going to continue. It's just going to be at a slower pace versus in 71 when Nixon just banged it and everybody freaked out, okay? So keep your eyes peeled on the dollar. I've been talking a lot about the dollar. Everything is so tied to the dollar right now that it's silly. So watch the dollar, watch the bond market, all right? Moving to the last thing here, earnings per share. This is interesting, okay? As of the end of July, and I haven't seen an update because we're only in mid-August here, but I will get you one. Of the companies that had reported through July, 81.9% of them had beaten their consensus earnings per share estimates. Yay! We should party for that. No, here's the deal. Since January, consensus estimates had literally been cut almost in half. Okay? This is where I get sick and tired of how you pop on CNBC. I call it the clown show. It is an unbelievable joke. If you watch CNBC, I hope I'm offending you because it's garbage, okay? It is a clown show. Here's what's fascinating. They're pumping up earnings per share. Oh, people are excited. Oh, companies are doing so good. They're not, okay? There's an old cliche used that I'm going to close on that says this: if you set the bar low enough, you can just roll over it to beat it. Keep your eyes focused on the ball, people, like the Rockies are not doing. The Rockies suck right now. My son sent me a text the other night. He goes, Dad, it is painful being a Rockies fan. I'm like, it is. Kind of like a Kansas City Royals fan. You love the Royals. They win the World Series a couple years ago, and then all their good guys leave. It's painful. Sorry to digress there. So anyway, here's the deal. We got to keep our eyes on the ball. There's a lot going on right now. Here's what we are committed to. We are committed to quality. We are committed to focusing on growth and inflation and what is happening on those two paradigms. We are committed to watching the bond market and watching the dollar, and that is going to dictate how we continue to allocate our portfolios. That's what we are staking our claim in the ground on, and I hope that you do too. I appreciate everybody's time. It's always great to see you all. In closing, thank you for tuning in with me every week. It's a lot of fun. I get excited to do these because I love to talk about the facts and talk about all the different moving parts, and I hope it's helpful. If you have questions, shoot me emails. You guys are starting to reach out and say, hey, Craig, what about this? What about that? I love this stuff. I want to help you guys be better investors. I want to help you understand more of what's going on in the stock markets, in our economy, and in the global economy. So for Friday, August 21st, this is Craig Modelmach for this week's Wall Street X's and O's, and I am out.